So that is the broad picture at the moment, and of course developments continue to come in. Let's bring in Deon Gouws, who's the Chief Investment Officer at Credo. Very good afternoon to you, Deon, and thank you for joining us this afternoon. Let's perhaps start with an overall look at the reaction that the markets have had to the recent developments. It hasn't been as severe as one would have thought. Markets in the green largely today, based on that dovish tone that was communicated by the Fed. But what of the conflict? Have we seen a little bit of concern there?
Yes, thank you. It's nice to be chatting. I think in a nutshell, it's fair to say that the market's reaction since yesterday morning when markets opened across the world has been fairly muted. Whether that's a surprise or not, you'd have to look at historical analogies. In general, when these kind of events happen, and one might argue this is worse than many that we've seen before, and I think that would certainly be valid. But typically the market takes its time to work through some of the consequences. And frankly, from a market's point of view, the consensus quite often is that many aspects of the market may not be that much affected, depending on further developments in the coming days and weeks. So certain sectors specifically, of course, are very much affected. You've already highlighted two in the last couple of minutes. One is the oil sector. The other one is the airline sector. You mentioned earlier there that oil prices have been going up at something like 4%. Most of that move happened at the open yesterday. So today it's fairly flat. Yesterday it was up more than 3%. So that has an impact, obviously, on the oil price because people are looking at potential scarcity, potentially Iran, getting involved in the war and all the consequences from that. On the one side, when it comes to airlines, not all these airlines are listed. But if you look at listed airline stocks, they were down to the extent of 3 or 4% yesterday as well. And then, of course, you've got certain other sectors which are directly impacted by a potential war or by an actual war on the ground today. You've got some of the big multinationals like Northrop Grumman and Lockheed Martin that spring to mind. Those stocks were up double digits yesterday. The market hasn't opened yet today for them. So time will tell exactly how they respond further today. But I think in a nutshell, for most sectors, for most companies, it's been taking a bit of a wait-and-see attitude. Just on the whole, the S&P 500, the biggest index in the US, actually ended the day up yesterday, about 0.6%. It opened flat, just about flat, down about 0.1%, and traded around that for most of the day, but ended the day up more than 0.5%. So we'll have to see exactly what plays out today, but it looks like another relatively stable day in the markets.
Deon, how much does the market weigh on conflict developments such as this one, but also the interest rate outlook of the United States, for example? We might have gotten a bit of a dovish tone from the Fed this time around, but concerns around the outlook based on the inflation created by the rising oil prices may also have a spooking effect, if you will, on markets. So I suppose here we're just wondering, what do market participants focus closely on in instances of this nature, more of a conflict, but also, or rather the interest rate outlook that would be indicated by the United States?
Absolutely. And if we break that question down into two main parts, firstly, the impact of oil prices on future inflation and hence the part of interest rates. Clearly, that's a concern, and that's a very valid concern. Having said that, I think we have to understand that the impact on the oil price and the likely future impact on the oil price is perhaps not as extreme as we may have seen at certain points in the past, in a similar sort of conflict, if you can compare it to any other conflict in history. And the reason I say that, if you go back, for example, to the last major war in Israel, the Yom Kippur War, which was exactly 50 years ago, and that predated the sort of oil embargo of the 1970s, the spike in inflation, and all the sort of financial fallout that came as a consequence. The world has changed in one important way, at least one important way. And I'm now talking not about the political world, but the economic and ultimately financial world. And that is that in the 1970s, America was very much dependent on Middle Eastern oil. Today, they are essentially oil independent thanks to the wonders of the fracking industry. So yes, Middle East oil is still important. And at the margin, it will drive the global oil price and therefore have an impact on global inflation. But it's less important than it used to be. That's the one bit of comfort we can take from it from a market's point of view. And then the second question you asked, which relates to the Fed and their dovish stance, from a humanitarian point, it makes no sense to say this. But certainly as far as the markets are concerned, the Fed is ultimately probably more important for share prices and for financial markets than a war in most parts of the world. So yes, when the Fed makes any announcement, it gets analyzed to death. When the Fed surprises the market in either direction, it has a huge impact, and frankly, a bigger impact than what we saw in the market over the last 24 or 36 hours as a consequence of the war in Israel.
Thank you very much for that update. Deon Gouws, who's the Chief Investment Officer at Credo, joining us this afternoon to unpack some of the global economic or market implications of those geopolitical developments.